All right, everybody, let's kick this off. Thanks for joining. We're super excited about our first part of Dirty Little Secrets this year, and we're really excited to be in energy in 2025. So, first, we're going to kick it off with bringing in our CEO, Jim Simpson. Jim, welcome.
Thank you, Chris. Appreciate being here, and thank you all for being on the call this morning.
All right. Thanks, Jim. First question I have for you is, why did you form East Daily?
Well, Chris, I've been desiring to drive transparency in energy markets for the majority of my career. And I started East Daily in 2014. I noticed there was a big discrepancy between what commodity markets were signaling and what equity markets in energy were signaling. And I wanted to bring those two markets together. It really simply, hey, I thought there was a much better way to take what natural gas, crude oil, and NGLs were telling equity markets and actually form a much better view on the equity side, so equities would react and behave in a much more transparent, much more logical way than they were at that time.
Yeah, thanks for that, Jim. So the theme of this year's Dirty Little Secrets is commodity ties. Can you talk a little bit more about what that means to you?
Yeah, absolutely. So, when I traded gas in 2000, 2001, I never looked at crude. I never worried about ethane. I never cared about propane. And that's just all changed. These markets, today the team's going to go through the Bakken with you. And it's about the Bakken today. So if you are trading in the Bakken, if you're producing in the Bakken, if you're midstream in the Bakken, yes, today's very relevant. If you don't care about the Bakken, today's really relevant because it's about the Bakken. It's not about the Bakken. The Bakken is such a great microcosm of how natural gas, crude oil, and NGLs going forward are working together in ways that most of the people in the industry have never seen before or felt. So long-winded way, Chris, of saying if you just care about nat gas and it's all you're watching, you have a high likelihood of getting run over. If you just care about natural gas liquids and that's all you watch and care about, again, high likelihood you're going to get run over. If you just care about crude oil and that's all you're paying attention to, you're going to get run over. This is about these three commodities and understanding how each one of them impacts the other. And at the same time, the Bakken's a great, great, great micro example of what we believe here at East Daily. You should be able to put yourself in or at the well and be able to look all the way down the value chain and understand exactly where a molecule or a barrel coming out of that well is going and being burned or utilized, and see the rate of return of that molecule or barrel all the way along the value chain. Or the flip side of that is you should be able to put yourself at the export dock and be able to look all the way back up to where that molecule is being produced that's getting exported from the dock. And anywhere in between, put yourself at a fractionator, look left, look right, understand not only where those volumes are coming from, but what's the rate of return downstream of that fractionator and also upstream of that fractionator. And we believe it's possible to pull all this together such that you can view a market in a much more holistic way and understand the entire picture, not just one piece of what it's going to be a large puzzle.
Awesome. Well, thanks, Jim. As you can tell everybody, we got some big plans for 25, and this is the kickoff to it. So we're going to walk you through the Bakken and how to view all the molecules and how they connect from wellhead to downstream and vice versa. So I'm going to go through the agenda next, and then we'll kick it off with the analyst. All right, everybody, let's kick it off with the agenda. So first things we're going to do today is we're going to go we've added a new use case in Energy Data Studio. It's just one slide. I'm going to show you real quick how to access that, clients. Second, we're going to look into our U.S. production outlook for 2025. Then we'll dig into our Bakken production outlook for 2025. That's what we're all here for. Then we're going to go into our crude infrastructure is still going to be tight and how commodity ties come together. Then we're going to go into our NGL optionality. Commodity markets got it wrong. Equity markets got it right. We'll explain more about that here in a second. And then we're going to show you the upcoming sections of dirty little secrets that we have coming up. So without further ado, I am going to talk about our regions and basins. We've added a new region and basin tab. You can see it on the far right there. And what we've done is we've taken, I'll blow this out here, we've taken and we've put everything we have on the Bakken in a new region. So not only can you search by commodity or by capital intelligence, you can also search now by regions or basins. If you have any questions or you can't find it, please feel free to reach out. And bringing in here for our U.S. production outlook, I've got Maria, who heads up both our production outlook and our NGL product. Welcome, Maria.
Thank you, Chris.
So let's dive in. So first, let's look at our U.S. production outlook.
Yeah, so we expect growth across the three commodities. On the natural gas side, we see 2024 averaging 109 BCF per day and increasing to 115 by 2025. The main drivers are the Permian, the Northeast, and the Ark-La-Tex, which account for the vast majority of the growth. Looking at the crude oil, we see 2024 averaging 10.2 million barrels per day and increasing to 10.6 by next year. The main driver is the Permian, which was waiting for gas egress constraints to ease with Matterhorn coming online. In addition, basins like Powder River, Uinta, and the Balkan are expected to also see slight growth next year. Finally, on the NGL side, we see 2024 averaging 6.5 million barrels per day and increasing to 6.8 in 2025. Production growth will be offset by flat ethane production in the short term, but Permian will drive C3 plus production growth as an increase in export demand is around the corner.
Thanks, Maria. So one thing people are asking about is our gas Henry Hub forecast. Next slide. Let's run through that. We see some upside here.
Yeah, so it's an interesting topic for sure. We see the price setting at 3.50 in 2025, which is more than $1 above the 2024 average of 2.31. As you can see in the graph, next year we forecast a higher price than the strip due to storage deficit. And this high price scenario will benefit tier 2 basins like the Barnett, the Eagle Ford, the Green River, and the Piceance. There is also optionality for the Anadarko Basin to react, but this will only depend on how gas moves between South Texas and the Louisiana hubs.
All right, so we've got some growth drivers for this demand. Next slide, we'll dig into what those growth drivers are for that forecast there.
Yeah, so one of those drivers is demand. We now have a more complex demand equation. Domestic demand will be driven by upcoming data center projects, which will support steady gas demand through the end of the decade. We also have a higher exposure to international markets, which will be driven by the increase of LNG projects on the Texas-Louisiana coast. And by the end of the next year, we expect total feed gas demand to increase to 15 BCF per day.
And then we also have growth drivers from a production standpoint on efficiencies. So let's talk a little bit about those.
Yeah, so basins like Bakken, DJ, and Permian have been heavily benefited by a higher utilization of drilling technology. These include, but isn't limited to, longer laterals and multi-wet paths. And then once it's used, these technologies can be reflected on different well-to-rig metrics, such as higher well per rig rates, lower spot-to-spot rates, and higher gas and liquid IP rates.
All right, so you mentioned the Bakken. That's what we're here for. So those GOR rates, the increased GOR rates, are we seeing those in the Bakken?
Yeah, we're seeing that in the Bakken and also the Permian. As well matured, the pressure between the reservoirs decrease, which allows more natural gas to be released from the geologic formation. On the Bakken since 2016, the GORs have increased more than 90%, and this has obviously benefited the gas outlook on the basin.
All right, let's see. We're here for the Bakken. What's our overall outlook on the Bakken in general?
So we expect to have an average production in 2024 of 3.56 BCF of natural gas, 1.26 million barrels per day of crude oil, and 0.47 million barrels per day of NGLs. Something interesting about our Bakken model and data is that it allows us to have a high visibility on the gas side. This gives us a daily production view and help us understand the rest of the commodity value chain.
All right, thanks. I skipped a little bit there, but we kept it going. Let's dig in a little bit deeper on, let's look at our average to average in the Bakken.
Yeah, so across commodity, we can expect an average growth of 3.6% from the 2024 values I just mentioned. Gas production, we expect it will increase by 91 million cubic feet per day, crude oil to increase by 51,000 barrels per day, and NGLs to increase by 30,000 barrels per day.
All right, Maria, one thing we also watch is producer guidance to look for for our guidance for the next year. So what are we hearing from producers?
Yeah, so Cord, Hess, and Devon account for 44% of the total gas production on the basin. Even with them having different ways to report guidance, we see that across the board, there is an optimistic view towards 2025. For example, Cord, with the implementation of drilling efficiencies, is expecting to lower downtime and increase their base performance. On the other side, Hess is expecting an annualized 10% growth rate on their gas volumes from 2024 to 2026 and expect a similar scenario on the crude oil side. Devon Energy, with the acquisition of Grayson Mill, has revised up their crude oil guidance and is expecting to see a similar trend next year.
All right, we've gone through our base case. Now, there's always, let's sensitize this, play with some upside, downside. Which one should we go with first?
Always the upside, Chris.
All right, upside. I knew you were going to have that, say that, so I have the slide ready. All right, let's look at the upside.
Yeah, so as you mentioned, of course, there's an upside to our production scenario. Production could be higher if well outside the core have higher initial IP rates than expected. Similar scenario could be seen if GRs continue to increase in the following years. And another factor that could lead to a higher in-basin production can be price variation and market opportunities. For example, with the Bison Express reversal project, the Bakken could not have an opening to Wyoming and even eventually the West Coast markets, which could incentivize drilling programs in the basin.
All right, thanks. So let's move into our downside case, but there's a caveat to the downside case. I think you're going to mention it in here. Let's take a look at it.
Yeah, so I think the main source for a downside scenario will be lower rig counts, and these could be associated to merchant acquisitions. We have already seen the impact of consolidation in regions like the Permian. Another factor that could cause rigs to drop is WTI decreasing. However, these might be lower risk as producers in the Bakken tend to be hedged and are only drilling for one commodity anymore. Other source for a lower production output can be weather hazards, as they are becoming more common. These, as an example of this, is winter freeze-offs and fires, and this could impact our outlook. Another reason to see a slower pace of growth on the basin could be maintenance or force majeures. The aggressor processing constraints in one commodity will for sure impact the production of the other two.
Awesome, Maria. Thanks for joining us. I think one thing we're going to focus a lot on in 2025 is the commodity ties. You're not just drilling for one anymore. This is a good case looking at the Bakken. Appreciate your time, Maria.
Thank you, Chris.
All right, let's move on to NGLs. Here joining me on the NGL slides, got Ajay Bakshani again, who heads up our capital intelligence team, and then Rob Wilson, who heads up our analytics team and also does some NGL stuff. So thanks for joining me, guys.
Thank you, Chris. Happy to be here.
Yeah, Rob, I'm glad you do NGL stuff. I undersold that. Rob is our NGL analyst. So thanks. All right, first, we're going to take a quick look just at our overall production. You can see egress out is fine. We have growth in the Bakken, but there are some interesting stories, and we're not going to focus too much on the Bakken. The Bakken production is what we want, but we're going to focus on Conway. So for that, Rob, we got a question to answer, and I'm going to turn it over to you for that question to answer. And the question is, why would ONEOK put a frac at the Medford frac at Conway?
Yeah, and it's a great question, Chris. And one I had to ask Ajay about because from a commodity perspective, a supply and demand perspective, it didn't really make sense. But I'm going to lay out a few a few answers that ONEOK's management laid out, and then we're going to dive into which one we really think it is. So ONEOK said, well, the economics are good, and they are. Even if you're running a conservative case, you can get to 5 to 6 times EBITDA multiple if you're running that thing 2/3 full, maybe even less. So the economics are good. They're able to build it relatively cheaply because a lot of the infrastructure is already in place. If you recall, this is the frac that exploded in July 22, and they used the insurance proceeds from that to build a new frac in Mont Belvieu, which makes sense. That's where the demand is. So why not put more infrastructure where there's the most demand? Number two, direct route to incremental demand in the mid-continent. So instead of Conway to Belvieu as Y grade, and then back up to the mid-con as purity product, you can just fractionate the Y grade in Medford or the Conway market as opposed to the back and forth. There's not a ton of demand in the Midwest, which is where ONEOK's pipeline goes up into the Chicago area. Not a lot of growing demand there. Most of the growth is in the Gulf Coast, which is why, again, that's where they built the frac from insurance proceeds. Finally, the third reason for the Medford frac is to fractionate more NGLs in Conway, put them on Sterling, which has plenty of capacity, freeing up space for more Y grade on Arbuckle from Conway to Mont Belvieu. And ONEOK's management team specifically said this will accommodate volume growth from the Permian, the Bakken, and the Mid-Continent. We think, and the reason we start number three is we think that's the reason that's really driving this. The good economics are more of a byproduct, of what they're doing with the project. So Arbuckle, which is the pink and red shaded pipeline, that's highly utilized, 85% plus over the trailing 12 months into 3/31/24. I think it's very close to that if you take that through June. Sterling, however, which is the gray pipe east of Arbuckle, is very underutilized, or that pipeline system of purity product is very underutilized at about 36% over the trailing 12 months. So putting a 210 a day Medford fractionator in Conway, Kansas allows ONEOK to make more purity product for delivery in the Mont Belvieu on Sterling. And this new frac, by the way, can more effectively strip out ethane. The old one was able to do more ethane propane mix. This one can strip out ethane purity product. And at the same time, create needed space on Arbuckle from NGL growth in the Permian, Mid-Con, and the Bakken. So it really solves two issues. All right, well, Permian, Mid-Con, and Bakken, where do we think that growth is coming from? Well, a lot of it is obvious. It's coming from the Bakken. In midstream infrastructure has responded with significant pipeline new builds or expansions, predominantly Daytona and Bahia, but there are also expansions that are being done on Bengal, Epic, and Energy Transfer's Lone Star. So you don't really need space to go from the Permian to Mont Belvieu via Arbuckle. I mean, there's plenty of capacity being built for that. And in fact, you have a little bit of an overbuild for a period of time. In the Mid-Con, we don't have a lot of NGL production growth because in part the almost 2 BCF a day of rich gas going to the Gulf Coast is really displacing gas that has come down from the Mid-Con and putting pressure on gas prices. So we don't expect a lot of growth getting into gas dynamics from the Mid-Con. Really, where we expect it is the Bakken, and we've been understating NGL supply out of the Bakken for a period of time, and I'll explain why. It really answers the question that Chris asked earlier: why put a fractionator in Medford? And we're getting to it. To reject or recover, what's the price? And what do they say, Chris? Value is in the eye of the beholder. So what is the price and what is the value depending on who you are? What we're showing here is in the lower left, that's from our purity product energy data studio dashboard. all that orange is ethane that's currently being sold as gas. It's being rejected into the gas stream. But it's supply that you could easily grow without one single additional rig or one single additional dollar being spent from the upstream side. You just cool the plants, extract the ethane, it's there. You don't really need oil and gas growth. Okay, so let's talk about infrastructure. We have an Elk Creek 135-day expansion and a Double H 75-day expansion. Relative to our forecast of yesteryear, it doesn't really make sense. You have all this additional capacity and basically flat NGL growth. Doesn't make sense. So ONEOK extracts more ethane in the Bakken and ships it to the Conway, where it can, one, fractionate Y-grade in Conway and send it to Bellevue, or two, ship Y-grade to Mont Belvieu. And then potentially they could, and they have talked about, or even permitted for an export facility in the Mont Belvieu area. Another route they could go, and this is a little bit speculation city here, but they could be looking to underpin an ethane export facility. There is a lot of ethane demand occurring internationally. Satellite is a big player in ethane vessels and ethylene crackers in Southeast China. So the reason we didn't have growth is because if you look at the price of ethane, the forward strip 25 cents a gallon, with respect to the cost for a producer or a shipper to get it down there, your C2 or ethane netback is -5 cents. So you wouldn't extract it because your netback is negative. You especially wouldn't extract it when you compare it to the natural gas netback of about 15 cents. You'd basically be losing 20 cents a gallon by extracting ethane if you're a third-party shipper. However, if you're ONEOK in this picture, your netback is different because you're looking at variable costs to move ethane, to transport it and fractionate it, not the all-in bundled cost, and that's a lot lower. We estimate 9 cents a gallon, maybe even lower. So if you subtract 9 cents from 25, all of a sudden your C2 netback is 16 cents. One, that's economically a lot more beneficial than -5, but you do have to account for the opportunity cost. And when you look at the opportunity cost of selling nat gas, it's even positive there. So that does give you, a scenario where you would recover ethane. Now, the price of ethane in Mont Belvieu is critical to this. What's not embedded in here is C2 export economics. That would even further kind of incentivize ethane extraction in the Bakken. But really, when we say it's in values in the eye of the beholder, is ONEOK marketing and shipping these volumes, or is a third-party producer shipper? Makes a huge difference on the incentive to extract what you might otherwise leave in the gas stream. So again, at East Daily, we think it's critical to cover the companies that own and operate the assets, which is what Jay sitting to my right does. And really, this is this analysis is the result of a disagreement or tension we discussed between commodities, supply and demand, and equity markets. Commodity markets tell you reject ethane. Equity markets, as Jay reminded me, tells you extract ethane. So it's really the overlap of these two, which gives us this potential upside to ethane supply.
Thanks, Rob. Appreciate the time. Let's bring in Jay. Jay, you asked me a question, or I asked you a question. What are some other dynamics that optionality can create in the Bakken? And what you talked about was, hey, there may be something else going on, and with the Double H conversion. So I want to first just take a look at this is our peer comparison report that we look at. And so everybody talks about KMI and the Double H conversion. KMI in the Bakken doesn't have too much exposure, but what this does show us is Energy Transfer. They're up there with ONEOK as far as their exposure to the Bakken, and there might be a story there about what they can do with the Double H conversion.
Yeah, Chris. Thank you. And I'll just note that the vast majority of that exposure is on the crude side for Energy Transfer with DAPL. However, ET did acquire Crestwood, and that's really when it entered the G&P space within that region. And as we've hit on throughout the year, G&P is the gateway to downstream NGLs, and that's ET's bread and butter. And so I'm sure they would take the opportunity to capture those NGLs and get it through their fractionators if they could. However, as you could see from Rob's story, One Oak has a lock on NGL egress out of the basin. It would have been a very expensive and uphill endeavor for Energy Transfer to try and build their own NGL business, even with the Crestwood assets. Fortunately, KMI's Double H conversion provides some more optionality for them and could be exactly what they need to truly maximize the value of those assets.
Well, let's take a deeper look here, getting into the optionality they have. Okay, so again, I blew up Rob's slide here, but I added in the Double H conversion and then all the pipelines that come in, not just a One Oak system, but where we really want to focus on is this section here, and we'll get into this. And then, Jay, if you could walk us through how ET may play this.
Yeah, so converting Double H not only gives Transfer another option to move its and its producers' customer NGL volumes out of the basin, but it brings those volumes closer to an area where ET has its own pipe. So Double H ends in Wyoming, as we could see in these pictures, and that's only a short distance away from ET's White Cliffs pipeline. That's in Colorado in the DJ. So if ET can get those volumes onto White Cliffs by either building a short connection or maybe partnering with that P66 PRB line to get from Wyoming to Colorado, then it can eventually move on to White Cliffs, which can get those volumes to Conway and Mont Belvieu via P66's Southern Hills pipeline. So there's a lot of moving pieces here. Phillips 66 has its own NGL ambitions, and White Cliffs needs Southern Hills to get to Belvieu. But these companies and those specific pipes already have a working relationship. Phillips 66 actually has a lease on White Cliffs and to deliver volumes about 40,000 barrels a day into Southern Hills. Transfer and Kinder also have a decent working relationship on the interstate natural gas pipeline side of the business. So it's not completely out of the question that these midstreamers could find a way to work together and provide a new NGL solution.
Thanks, Jay. Keeping the possession of those molecules and optionality are big themes for 2025. Clients, if you have questions on how ET might be able to capitalize on this, always reach out to Jay. We'd love to hear from everybody. So that concludes our webinar today. Thanks, Rob and Jay. Next webinar, Take Me to the Gulf. We're going to be covering basically everything down in the Gulf, Permian, Haynesville, Houston Ship Channel, what's going on, and from a commodity ties angle. So don't forget to sign up for that. We have free newsletters. Hit those up, please. And then again, thanks for joining. We'll see you on the next webinar.